Welcome to our comprehensive guide on depreciation. In this video, we'll break down the essential concepts you need to know, from the depreciable amount to the different methods used in practice. Whether you're a student, an accounting professional, or just curious about how businesses manage their assets, this video will provide clear explanations and practical examples. We'll also discuss how estimates like useful life and residual value play a role and explore real-world scenarios, including a case study on component accounting. Let's start by understanding what depreciation really means and why it's so important in financial reporting. Depreciable amount is a key concept in accounting. It refers to the cost of an asset or another amount that substitutes for cost, less its residual value. In simple terms, it's the portion of an asset's value that will be allocated as an expense over its useful life. Understanding this amount is crucial because it forms the basis for all depreciation calculations. For example, if a company buys machinery for $10,000 and expects to sell it for $2,000 at the end of its useful life, the depreciable amount is $8,000. This figure will be systematically expensed over the asset's useful life. Two important estimates in depreciation are useful life and residual value. Useful life is the period over which an asset is expected to be available for use by an entity. Residual value is the estimated amount that an entity would currently obtain from disposal, after deducting estimated costs of disposal, if the asset were already of the age and in the condition expected at the end of its useful life. These estimates require judgment and can significantly impact the depreciation expense recognized each year. Regular review of these estimates is necessary to ensure they remain appropriate as circumstances change. There are several methods available to allocate the depreciable amount of an asset over its useful life. The choice of method should reflect the pattern in which the asset's future economic benefits are expected to be consumed. The most common methods include straight-line, reducing balance, and units of production. Each method has its own logic and is suitable for different types of assets and usage patterns. Let's take a closer look at each of these methods to understand how they work and when they are most appropriate. Straight-line method is the simplest and most widely used depreciation method. It allocates an equal amount of depreciation expense each year over the asset's useful life. This method is ideal when the asset is expected to provide consistent benefits throughout its life. For example, if an asset has a depreciable amount of $8,000 and a useful life of 4 years, the annual depreciation expense would be $2,000. This approach is straightforward and easy to apply, making it a popular choice for many businesses. Reducing balance method, also known as the declining balance method, accelerates depreciation by applying a fixed percentage to the asset's carrying amount each year. This results in higher depreciation expenses in the early years and lower expenses in later years. This method is suitable for assets that lose value more quickly in the initial years, such as technology or vehicles. For example, if an asset's carrying amount is $8,000 and the depreciation rate is 25%, the first year's depreciation would be $2,000, with subsequent years calculated on the reduced balance. Units of production method bases depreciation on the asset's actual usage, output, or activity level. This approach is ideal for assets whose wear and tear depends on how much they're used, such as machinery or vehicles. Depreciation expense is calculated by dividing the depreciable amount by the total estimated units of production, then multiplying by the actual units produced in the period. This method ensures that depreciation aligns closely with the asset's economic benefits. Component depreciation is applied when an asset consists of significant parts with different useful lives. Each component is depreciated separately, reflecting its own pattern of consumption. For example, an aircraft's engine and its body may have different useful lives and should be depreciated individually. This method provides more accurate financial reporting, especially for complex assets, and ensures that each part's expenses match to its economic benefit. It's important to regularly review the useful life and residual value of assets. Changes in technology, usage patterns, or market conditions can affect these estimates. If circumstances change, the depreciation calculation should be updated prospectively, ensuring that the financial statements remain accurate and relevant. This review process helps companies avoid over or under-depreciating their assets and provides stakeholders with reliable information. In estimates such as useful life or residual value change, accounting standards like IAS 8 require that these changes be treated as changes in accounting estimates. This means the new estimates are applied prospectively, affecting only the current and future periods. Prior periods are not restated. This approach ensures that financial statements reflect the most current information without altering historical data, maintaining both relevance and comparability. Let's walk through a simple depreciation calculation using the straight-line method. Suppose a company purchases equipment for $12,000, expects a residual value of $2,000, and estimates a useful life of 5 years. The depreciable amount is $10,000. Dividing this by 5 years, the annual depreciation expense is $2,000. This amount will be recorded each year, reducing the asset's carrying value on the balance sheet and recognizing an expense in the income statement. Now let's try the reducing balance method. Using the same equipment with a $10,000 depreciable amount and a 30% depreciation rate, the first year's depreciation is $3,000. The carrying amount for the next year becomes $7,000 and the next year's depreciation is $2,100. This pattern continues, with the depreciation expense decreasing each year. This method is particularly useful for assets that lose value quickly in the early years. The units of production method: suppose the equipment is expected to produce 50,000 units over its useful life. If it produces 10,000 units in the first year, the depreciation expense for that year is $2,000, calculated as $10,000 depreciable amount slash 50,000 units, x 10,000 units. This method ensures that depreciation matches the asset's actual use, providing a more accurate reflection of its consumption. Imagine a building with a roof expected to last 15 years and the rest of the building expected to last 40 years. Under component depreciation, the cost of the roof and the building are separated, and each is depreciated over its own useful life. This approach ensures that when the roof is replaced, only its carrying amount is derecognized, not the entire building. This method provides more accurate expense allocation and better reflects the asset's consumption. Let's discuss a real-world case involving component accounting. A manufacturing company owns a complex machine with several major parts, each with different useful lives. By applying component depreciation, the company can replace and depreciate each part individually. This not only improves the accuracy of financial statements, but also helps in budgeting for future replacements. Component accounting is especially important for industries with large, complex assets. Regularly reviewing useful life and residual value estimates is essential for maintaining accurate financial records. Changes in technology, market conditions, or asset usage can all impact these estimates. By updating them as needed, companies ensure that depreciation expenses remain relevant and reflect the true economic reality. This process also helps prevent significant adjustments in later periods, supporting smoother financial reporting. IAS 8, Accounting Policies, Changes in Accounting Estimates and Errors, provides guidance on how to handle changes in depreciation estimates. When a company revises its estimates, the changes are applied prospectively. This means only current and future depreciation expenses are affected, ensuring that financial statements remain consistent and comparable over time. Understanding IAS 8 is crucial for anyone involved in asset accounting. Some common mistakes in depreciation include failing to review useful life and residual value, using an inappropriate method, or not applying component depreciation when required. These errors can lead to misstated financial statements and poor decision-making. It's important to follow accounting standards and regularly review asset information to avoid these pitfalls. Proper training and internal controls can help ensure accuracy. Accurate depreciation provides several benefits. It ensures that expenses are matched to the periods in which assets generate revenue, leading to more reliable profit figures. It also helps companies plan for asset replacement and manage cash flows effectively. Accurate depreciation supports better decision-making and enhances the credibility of financial statements for investors and stakeholders. Let's recap the key points covered in this video. We discussed the concept of depreciable amount, the importance of useful life and residual value, and the main depreciation methods: straight line, reducing balance, and units of production. We also explored component depreciation, the need to review estimates, and how changes are handled under IAS 8. Accurate depreciation is essential for reliable financial reporting and effective asset management. Conclusion: understanding depreciation is fundamental for anyone involved in accounting or asset management. Always ensure that you use the most appropriate method, regularly review your estimates, and apply component depreciation when necessary. Stay updated with relevant accounting standards like IAS 8 to maintain compliance. With these practices, you'll ensure that your financial statements accurately reflect your assets, value, and support sound business decisions.